Before we start the video, please take some time to read through the important notes and disclaimer. Do note that investments always involve risk and the possibility of losses. Any reference to prediction, projection, forecast on the economy, stock market, bond market, or the economic trends of the markets or past performance is not necessarily indicative of and is no guarantee to the future or likely performance of your investments.
Hi everyone, I'm Jalissa, the investment analyst at AutoWealth. Here with me is our Chief Investment Officer, Taiji, and together we'll walk you through the future of digital economy portfolio.
Thank you, Jalissa. Today, we will be introducing to you the future of digital economy portfolio. As the name suggests, this portfolio aims to capitalize on the multi-decade trend of digitalization by diversifying into e-commerce, internet, and fintech. All of our portfolios are specially curated by the investment team to reflect a particular theme or investment strategy that aims to deliver strong returns. Our portfolio curation process largely includes these three simple steps. Firstly, extensive qualitative and quantitative analysis is carried out to determine the sectors that express the investment theme. The ETF weightage is then derived to track the respective sector's market capitalization. Secondly, our team then screen over 10,000 available ETFs listed globally and select the best ETFs for your portfolio based on various criteria such as diversification effect and risk-adjusted returns, etc. The process doesn't stop here. Our portfolios are reviewed regularly to ensure that the underlying ETFs are consistently the best ETF available in the market, and the allocation weightage is relatively consistent with the market. Now, Jalissa will share more about why you should be investing in the future of digital economy portfolio.
Thanks, Taiji. To start off, here we have the 5-year performance of the ETFs in our digital economy portfolio compared to the benchmark of the MSCI All Country World Index. Unfortunately, tech stocks have not performed well so far this year, and we can observe an underperformance in sectors such as e-commerce, fintech, and emerging market e-commerce and internet. The internet sector, however, significantly outperforms the benchmark and leads the overall weighted average of the digital economy performance to outperform the benchmark as well. Now let's dive into individual sectors. Let's first take a look at the e-commerce sector. So we see an e-commerce boom with e-commerce accounting for 22% of sales globally, and the industry is likely to experience a 400% growth in global sales volume in the next few years, producing a compound annual growth rate of 16.7%. The acceleration from 2020 onwards is due primarily to the COVID-19 pandemic, which created a global e-commerce surge as online shopping became a practical alternative to traditional retail. Artificial intelligence is becoming a great force in the e-commerce industry in recent years as it improves the e-commerce journey with the help of virtual assistants and intelligent product recommendations. The market for AI-enabled e-commerce solutions is projected to hit $16.8 billion by 2030. So more than 50% of companies have started to adopt AI, and 79% of businesses that integrated AI into their marketing and sales processes have reported a positive impact to their business revenue, signaling the potential for the growth in the e-commerce sector. Next, taking a look at internet services, we saw the global market growing to more than $450 billion in 2020 and is projected to reach a size of over $632 billion by 2027, resulting in a compound annual growth rate of 5%. The internet sector has been growing steadily for the past 2 decades due to the effects of digitalization, and it will only continue to permeate every aspect of our lives. Now, looking at the technology breakdown of our internet ETF, we see that cloud computing and digital media make up more than 40% of the whole sector, followed by e-commerce, blockchain, and Internet of Things. In the next 2 slides, we will further discuss how cloud computing and digital media plays a critical role in driving internet growth. So the cloud storage market is predicted to grow at a compound annual growth rate of 26.2% from 2021 to 2028, and we observe new technological trends such as automation and AI to supplement the cloud storage capabilities, which will reinvent work dynamics for firms globally. So cloud storage has the ability to contain big data and protect it from any potential threats that would affect the data if kept in traditional storage facilities. As cyber attacks becomes more prevalent, this makes cloud storage extremely essential in today's society and will only become more important in the next few years. Next, growth in digital media is mainly driven by the video games market, and revenue in the video game sector is expected to hit 235 billion in 2022 and grow rapidly to reach 321 billion in 2026. The video games industry drives the digital media segment, especially when the COVID-19 lockdowns brought a boom in social and casual gaming. So video games have become a staple form of entertainment in our lives, and its growth will only fuel more innovations and reinvent the digital media industry. Another theme in this portfolio is fintech. So during 2021, interest and investment in fintech grew significantly in many regions, transforming the way financial services cater to consumers and businesses alike. The growing maturity of a number of fintech subsectors such as payments, enterprise solutions, and blockchain are expected to keep investments high in this sector. Payments include mobile payment and e-commerce payment. Enterprise solutions are technology solutions for businesses in the realm of financial services, and blockchain harnesses its distributed nature to provide technology solutions. Looking forward, here are some of the top trends for these subsectors. First, we have payments. So digital payments comprise digital commerce such as buying goods or services via the internet, and mobile payments such as using smartphones to pay digitally. With their convenience, both are expected to proliferate over the next few years, increasing at a compound annual growth rate of 16.5% through 2024. So companies that may potentially capitalize on digital payments include payment networks such as Visa or PayPal, and software companies such as Block and Aiden that create the interfaces to accept payments. Next, enterprise software are primarily used to satisfy various business needs. It helps companies meet their goals by boosting enterprise productivity and efficiency. So for example, through helping to track and improve supply chains, interact with customers, or manage resources. The industry is expected to record strong growth in the coming years and is forecasted to grow to 424 billion by 2025. With digitalization and more data collected online, companies' needs for data insights, customer analysis, and all kinds of business processes are expected to continue growing. So Pfizer, one of the largest enterprise solutions providers, provides software solutions to Coca-Cola and Citi Financial, to name a few. Many companies are also incorporating blockchain technology into their services. So today, blockchain potential applications include securities, smart contracts, digital currency, and record keeping. So in securities, banks use blockchains to protect against cyber attacks and hacks, since all information are stored in one place. By using blockchain, banks can harness the distributed nature of blockchain to reduce the risk of hacks. Lastly, we have e-commerce and internet for emerging markets. So for e-commerce, we see that 8 out of the top 10 countries ranked by e-commerce sales growth in 2021 are emerging markets countries, and their e-commerce sales growth significantly exceeds that of the US. The emergence of this phenomenon is primarily due to the emerging economies investing in technologies and digital infrastructures, which drive internet penetration rates among consumers. Looking at the internet and smartphone penetration in the emerging market economies, we see a significant digital boom over the last decade, and these numbers are still increasing over time. By 2022, the number of internet users living in emerging markets is estimated to reach 3 billion, and there will be 3 times as many internet users in emerging markets compared to developed markets. Furthermore, government interventions such as the Internet Plus strategy in China helps to promote the integration of IoT into many sectors and is expected to further this growth. Finally, why do we allocate 10% to a minimum volatility ETF, in this case USMV, in our portfolio? So the minimum volatility ETF sits to track the index composed of US-listed firms that exhibit low volatility characteristics, which help to provide downside protection for your portfolio. As seen from the left chart, minimum volatility have a track record of delivering market-like returns with less risk, as they have historically been more defensive during market declines, while still capturing meaningful gains during upswings. During market volatility, USMV is observed to lose only 67% of the total loss accumulated by the benchmark. This is again proven during the COVID sell-off period where S&P 500 recorded a 12.35% decline, while USMV recorded a slightly smaller decline of 11.93%. All investments involve risks, and here are some key risks you should be aware of. So for the e-commerce sector, trademark infringement is a prevalent issue as some suppliers replicate and sell low-quality counterfeit goods globally at the expense of original businesses. So to mitigate this risk, trademarks and intellectual property laws saw greater emphasis in recent years to allow for legal action to be taken against such infringements. For the internet sector, cybersecurity is a key risk as we saw more cases of hacking and disruption to computing systems. This causes internet companies more susceptible to data exposure, malware, and productivity loss. To tackle this, many companies today carry out routine enterprise vulnerability assessment and continuously monitor the network for new and unknown devices to assess how safe these devices are to their systems. For the emerging markets, regulatory risks could hinder their growth. For example, China's President Xi Jinping crackdown under the Common Prosperity Policy have depressed large technology conglomerates. However, we expect the political impetus to ease after President Xi secures his third term. Lastly, aggressive interest rate hikes could inhibit growth in non-mature sectors such as fintech. Valuations of fintech companies are particularly penalized as exponential future earnings growth are discounted at elevated cost of capital. That said, interest rate hikes are projected to moderate significantly in early 2023 and even reverse slightly in the second half of 2020, lifting the fintech sector appeal. Moving on, Taichi will share more on the potential risks and returns.
So, what are the risks and performance numbers like, and how does it perform compared to a benchmark? Technology stocks have taken a beating this year amidst aggressive interest rate hikes. As a result, the portfolio has underperformed compared to our reference benchmark, the MSCI All Country World Index. The Future of Digital Economy portfolio achieved a 5-year annualized returns of 7.13% compared to an annualized return of 8.79% for the benchmark. From a risk perspective, the portfolio's annualized volatility of 25% is slightly higher than the relative benchmark. On the maximum temporary drawdown, an indicator of downside risk, the portfolio recorded a maximum drawdown of negative 66%. The portfolio has a Sharpe ratio of 0.23, while the benchmark has a Sharpe ratio of 0.33. Overall, we expect the environment to become conducive as inflation and interest rate hikes moderates meaningfully in early 2023. The portfolio presents compelling opportunities for long-term investors looking to capitalize on the currently depressed price levels and benefit from a fast-growing multi-decade theme. As mentioned in our introductory video, AutoWealth Plus portfolios are 100% equity and tends to be more volatile than the AutoWealth Starter portfolios. The Future of Digital Economy portfolio is ideal for investors who believe in the multi-decade trend of economies embracing digital transformation. As the underlying sectors can be volatile, an investor should have a longer time horizon of at least 5 to 10 years with a high risk tolerance to withstand market volatility. If you are interested, all you need to do is to follow these 3 simple steps to create an AutoWealth Plus portfolio today. Firstly, to open an account with us, you need to head over to our website and click Get Started. Next, you will create the AutoWealth Plus portfolio by clicking on the Plus tab and follow the instructions to fill up your goals, information, and risk assessment. Lastly, you may pick a preferred AutoWealth Plus portfolio and start funding your account. Thank you for watching till the end. If you have any queries, please visit our website or drop our client services an email. Help us to improve our video content by scanning the QR code. Also, do look out for our next few videos as we deep dive into the other AutoWealth Plus portfolios. Stay tuned, see you there.